Good morning. In order to avoid any further delay, we are going to begin the session, but please accept in advance my apologies if things are a bit fluid, in that we might indeed welcome Sheikh Mansouri as a keynote speaker in the course of the session to offer an intervention, and we might also add one other panelist as we move forward. But that said, we have a distinguished panel already, which is reason enough to begin. Now, this session about UAE high flyers is a perfect segue from the last one. With those of you who were already here know that that was about discussing investing in the UAE. Here we're going to see how the UAE is providing a very fertile launch pad for the growth of UAE-based multinationals and the impact that they're having around the world. Indeed, the UAE then clearly has been talked about as a destination and as a transit point, but now it is truly an origin of capital that flows worldwide and of companies that are becoming quite influential on the world stage. Here, of course, we have a vast range of industries represented not just on this stage, but here at this event. When you think about UAE multinationals in banking and financial services, hospitality, food and agriculture, metals, mining, construction, logistics, and so forth, all of those sectors are represented now by very major UAE-based companies, and that's a very obviously promising sign. We might also hear from, over the course of this session, representatives from countries that have been beneficiaries of some of this UAE-based outward investment, such as Morocco, China, Canada, and others. What I'm going to ask each of our distinguished panelists to comment on are some of the fundamental issues around what have been the key financial drivers of their success, what have been the factors that have helped them to break out internationally, what are the key destination geographies of their investments, and so forth. Now, joining me on the stage, as mentioned, is a very distinguished panel, starting here at the left, Mr. Douglas Kirkman, the CEO of ICD Brookfield, the major commercial real estate fund, Mr. Masood Ali of Dubal, Mr. Mustafa Abdel Wadud of Abraj Capital, Mr. Rashid Al-Javan of Dana Gas, and Mr. Adel Taki of Damak. So I might begin the panel in the order of seating, and we'll start with Mr. Kirkman, who's in running a joint venture multinational based here in the UAE, can tell us about some of the issues that have driven the decision to locate here and to expand from here and use this as the base for global operations.
Thank you very much for that. ICD Brookfield is a real estate fund that's actually focused primarily on investing into Dubai and the UAE and trying to bring real estate solutions, commercial real estate solutions to this market for multinationals and corporates who are looking to either relocate or grow here in the region. It's a joint venture between the Investment Corporation of Dubai, who are the owner of many of the state's assets here, whether that's Emirates, whether that's Donata, certainly the financials and the energy sector, et cetera. And Brookfield Asset Management, which is a publicly traded alternative investment management company, trade on the New York Stock Exchange. We've got about $180 billion in assets under management. We were very pleased when the Investment Corporation of Dubai considered us, Brookfield Asset Management that is, as a joint venture partner. They were, I think, looking to bring a global real estate investment management company into the region to help bring further sophistication to both the capital markets and the real estate solutions, being provided in the region. And, we saw the UAE and Dubai as a wonderful partner because as we look at the growth in the global economy, it's very clear that the developing, economies of what I would call the Manasa region, Middle East, North Africa, and Southeast Asia particularly, through to China, are growing at circa 3x the level of the developed world, where Europe is stagnating and not growing at all, and the U.S. is growing anemically at circa 1%. And so, as we look at investment management on a go forward, We believe that the Manassa region is where growth is going to happen, where more and more capital will be invested. And there is no better place to start that than from here. Both is physically a launching point, as you've got within a 4-hour flight, a third of the world's population, within an 8-hour flight, 2/3 of the world's population. But I think also, it is representative of what we would be looking for in other countries, meaning, infrastructure for the growth in businesses, whether that's the airports or the ports here. The airport's now the second largest in the world in terms of international flight passengers. The port is the 8th largest in the world and the largest outside of Asia. The road system, the sort of ease of doing business, etc. To me, those are the drivers of the success of Dubai and the UAE, and are what will be the drivers of success, in other countries, sort of as we go forward.
Let me ask you a quick follow-up. As you look at this Manassa region, as you've described it, where do you see the biggest infrastructure gap? Because all of these, particularly post-colonial countries, have a legacy of not investing sufficiently in infrastructure as their populations have grown in the last 50 to 60 years. So as you look at this broad region, no doubt it is most of humanity. But when you're doing your specific targeting, so to speak, where do you see the biggest infrastructure gaps?
Well, as a general point, I mean, many of the countries in Africa will benefit on a go forward through additional infrastructure investment. We today, outside of the UAE, are very focused on India, where we've got existing investment platform. One of India's issues is that they suffer from the reality of they are a democracy, and that sometimes can make it slightly more difficult. To push forward infrastructure projects that are sort of crossing over either political geographies or various levels of government. Actually it's interesting. The port here in Dubai benefits greatly from goods that are actually flowing from South India to North India.
Right.
Rather than take them up the roads themselves within India, they will come via, ship to here, break down the containers, repack and ship on to North India, and that's not great when talking about the infrastructure in India.
That's very revealing. If you could, let's pass the microphone to Mr. Rashid Al Jawan, CEO of Dana Gas. Given the enormous resources, energy resources distributed across the region, could you tell us a bit about how you're strategizing to expand and to lead this sector, not just for the UAE, but regionally?
Thank you. Bismillah ar-Rahman ar-Rahim. Well, ladies and gentlemen, good morning. We don't see much of you, but I'm sure we are very visible.
They're listening intently.
On the other side. Actually, if I just give a few introductory notes, even though Dana Gas doesn't need any more introduction, but Dana Gas is a public joint stock company which is focused on natural gas development. The natural gas value chain extends from the upstream exploration and production into midstream, which is the transportation of the natural gas, and the downstream, where you supply the gas to end users. The end users could vary between petrochemical industries like fertilizers, or the main driver for natural gas utilization really is the power generation. The company, since inception, the original founders, the core founders, have realized how demand is growing for power generation, basically. There are, unfortunately, a lot of parts of the world where they are still lacking sufficient electricity. There are numbers thrown, billion people, for example, who lack the basic requirement of electricity. So this really what drove the original founder of the company, which was incorporated in late 2005. The company is headquartered in Sharjah, but and it's a listed company in the Abu Dhabi Stock Exchange, Abu Dhabi Security. The company is focused, as I said, primarily in two things. One is to work and develop the natural gas resources. And the second is that we are regionally or geographically, we are a MENASA-focused country. So it's not localized areas. Our current assets portfolio extends from here in the UAE. We are a Sharjah-based, headquartered. We have our biggest operation is in Egypt, where we're developing the Nile Delta gas fields on a 100% basis for Dana Gas, and in joint venture with others in the Kurdistan region of Iraq. The company now, as stands, produces around 60,000 barrel oil per day equivalent. When we say that terms, that means we're doing a lot of natural gas production, condensate, and LPG. What is driving the company's formation is the basic necessity and requirement for power generation as generated by natural gas, rather than using the other alternatives such as diesel oil, which is more expensive, more pollutant to the environment, and less efficient when it comes to the actual power generation. That's why gas stands to be the more attractive alternative source of power generation.
Let me ask you a follow-up. As you mentioned at the very end, it is becoming the more attractive alternative global fuel, but also there is a huge oversupply. Where do you see then, given the growing regionalization, and this has been asserted by many analysts of the energy industry, growing regionalization of global gas markets because of the huge supply, where do you see revenues, profits coming from in the years ahead?
Very good. If I go back in history, I started as a petroleum engineer more than 30 years ago. And those days, companies all over, global, international oil companies, major oil companies, the main drive was to search for oil rather than gas. And if they discovered gas, then it's a bad story. Gas will be flared, and if it is an associated gas to the oil, in order to produce the barrel of oil, you have to produce the oil plus the associated gas. You would burn the gas in order to get the oil. Now, with time, the world realized that there are more monetization, more value to be retained from the natural gas. So slowly started to segregate the gas and not only use it for local demand, but there was a huge demand for it for export purposes. How do you export natural gas? If the market is close by, you would lay a pipeline and transport it. If the market is a long distance, such as Japan, you have to convert your gas into a liquefied natural gas, i.e. you convert it from gas to liquid, transport it by ship as a liquid product, move it to the consuming markets such as Japan, for example, where the process will be reversed. They'll receive it as liquid, then immediately transfer it to gas and burn it into power generating, to generate electricity. So the value has increased tremendously from being a waste product into a highly demanded, clean source of fuel for power generation. With such a realization and monetization of the gas, then a lot of development went into gas only purely. So now we've seen a shift. So we say the 20th century was the century of oil, the 21st century was the century of gas. And then you saw a lot of project development focused only on natural gas development, LNG, pipeline gas, and that encouraged investment and therefore more supply. But gas still failed to reach, in terms of monetary value, the level of the oil when it comes to the unit for the million BTU of gas. So you're getting the same amount of energy, but different sources, but different prices as well. So the gas still suffered from undervalued fuel of energy. This triggered also that rather than just looking for associated gas while you're looking for oil, then there was a focused attention on searching for gas only. So you saw a lot of initiatives in Saudi Arabia, here in the UAE, elsewhere, to look for gas. With good success of finding the gas, and the demand was extremely high from the Western American markets, the European markets, into the Far Eastern market, Japan, Korea, then also you talk about India and China. Now, I'm sorry your question deserves a long answer, really. I can stop here, or I can also start to answer you and later on the shale gas, which made gas more abundant. I will stop here, not talk about shale gas, but because shale gas was found, then we've seen a high supply, as you call it. I would still consider it localized supply because it's highly used in the US, but we still see Europe, but mainly China and India are in need of gas. Lastly, to close, I would say, while gas started as an undesired requirement, then it became an export. The third stage was gas was needed locally. So while Abu Dhabi was the first GCC place to export gas, now they started to import as well. They've seen a rise in the local demand for natural gas, and this is happening elsewhere.
Excellent. Well, it's as a takeaway, I think we can all appreciate that that not only the GCC region, but the UAE is poised to capitalize, in other words, not only on the, as you said, the 20th century fuel of oil, but of course the 20th century fuel of gas. Let's, thank you. Let's pass the microphone to Mustafa. Oh, he has one. Okay. Who's of course partner in the very well-known, largest private equity firm in the region, Abraj, which has truly become a brand name. But those who watch the firm know that in the last couple of years, there's been a much bigger emphasis now strategically on thinking about much further off geographies. And given the theme of this session, if you could elaborate a little bit more on the global outlook for the company, that would be excellent.
Sure. Just by the way of background, we started, like my two fellow panelists here, focusing on the Manassa region, and this was about 11 or 12 years ago. Since then, as you mentioned, in the past few years, we've managed to leverage the growth that we've experienced on the base of our UAE and regional presence. And now we operate with physical offices on the ground in about 33 countries and investments in about 40 countries, everywhere from Peru to the Philippines. So we are private equity investors in growth markets. We don't look at developed markets, we look at what people call the emerging markets and what we like to call growth markets because of the opportunities they offer. So we're focused on Latin America, Sub-Saharan Africa, MENA, Southeast Asia, the subcontinent, with an active presence and active investments in these places. And I think particularly relevant for this session, we started out focusing on this region with a UAE presence. So we're a homegrown story, we're a private sector business, very international in terms of our investor base, very international in terms of our employee base, and so it's almost a reflection of how Dubai operates. And I think the fact that we started out in Dubai was a great push, because we looked at markets where you had to be part of the information flow, and Dubai just sits specifically, in the UAE in general, in that corridor of trade flow and investment flow, and more importantly, information flow between Asia, Africa, the GCC, the MENA region. So in a way, what looked like an odd location to set up a private equity business at the time, 12 years ago, ended up giving us a very special access to some very high growth regions with a physical presence on the ground. And over a period of time, we've replicated that model to go elsewhere. And I think the reality is, if you look at the business we're in, which is investing in growth companies and growth opportunities, the real opportunity across the world has been effectively the Southern Hemisphere and these growth markets. So for us, it's been for all the reasons that were highlighted above, if you look in hindsight, why the UAE? Great quality infrastructure, the connectivity, flying in and out of locations with, I mean, if you look today, we're serviced by a combination of Emirates, Etihad, Air Arabia, Fly Dubai. You can get to any destination within anywhere of the markets we want to be in very, very quickly. And again, when you look in terms of other infrastructure that's been built, I mean, we talked about the road infrastructure, but where we are as well, what's relevant is the regulatory infrastructure and the themed concepts that have been developed, such as the DIFC. Today, every service provider I need to interact with as a firm is within a square mile of where my office is. So whether it's an accounting firm, a bank, a consulting firm, they're all represented here, all the global names, all the regional names. And for us, that's extremely convenient to have that sort of immediate access. So I think all of that soft infrastructure has helped us tremendously in sort of growing our business.
Just a quick follow-up, if you could, yesterday on one of the earlier panels, Ms. Patricia from the ITC was saying that, emerging markets that are seeking to attract FDI are no longer preferencing, known Western companies, and they don't even care whether the source of capital is a state-owned enterprise or a private enterprise. They want to see investment from companies that share their values, which is to say creating local jobs, building local businesses and so forth. And that was a very good point. So if you could touch a bit on the places where Abraj as an investor sort of resonates the most, and also just touch on some of the more difficult geographies. You're looking at sub-Saharan Africa, you're looking at the Andean region, you're looking at Pakistan. For the Western mind, these are not the safest geographies to be investing in, but you are rolling up your sleeves and moving right in. So if you could just touch on those 2 points.
Sure. I think when you look at these geographies, the immediate reaction, I guess it's the CNN effect, if you will. People think of the risks that are associated with these markets, but with any market, there's risks. If we talk about the global financial crisis, for example, and the risk that posed to the global financial system, that did not come from the emerging markets, what we call the growth markets. So there's a lot of risk in general when you're investing, and some of the biggest ones may not exist in these markets. You just get a very different subset of risks. And I think the easiest way to de-risk a business is being physically present on the ground, because then your vantage point is extremely local. So you should not lose perspective, but you should also be extremely local. And if you look at anybody across here that sits with me on this panel that has operations that are in emerging markets, they sit locally and they have presence locally. And that's the best way to be able to get the right view of the different opportunities. So we are in markets that have their specific challenges, whether it's political risk, currency risk, all other kinds of risks, but also these are markets that are growing very, very quickly. So I am willing to trade off, and my investors are willing to trade off some of that risk for the increased returns. In today's world, what returns can you get in a zero growth market? Right. Very limited. Yeah. And we talked about the US at anemic growth. We talked about Europe at no growth. And if you look at the emerging markets, even with the current slowdown, there's significant growth in these markets. Now, if you choose the winning businesses within these markets, and you focus on these businesses and you provide them the support and you instill the sense of governance that's needed to take them to the next level, and you widen the bench of management of these companies and you help them with their growth strategies, then that's another turbo boost to returns that more than compensates for the risk you do. And then obviously we have a very strong focus on risk management with a group of people that are focused exclusively on that, and we manage it in many ways. But I think it's increasingly the world is waking up to see that whereas 75% of the world economy is the OECD countries, 2/3 of the world growth is coming from the so-called emerging markets. So where do you really want to be investing? There is a significant shift to these emerging markets. And historically, if you're sitting in New York or London and you think emerging markets, you're thinking BRICS. Immediately, that's the most obvious thing, Brazil, Russia, India, China. But there's a whole world out there beyond the BRICS. Mm-hmm. And access to these markets is going to be increasingly relevant. And individually, they may be smaller opportunities. In aggregate, it's a tremendous opportunity.
I've always liked to refer to the GCC in a way as the brick, as another brick that doesn't get named because it wouldn't fit neatly into the acronym. But that said, we all have our own acronyms now to capture the high growth markets. And let's pass the microphone, thank you again, to Mr. Masood Ali. And as we do, let me remind the audience that we will have some time for some questions. In fact, we may bring in some questions right after this first round. So please do raise your hands when the time time comes. Mr. Ali, Vice President of Dubal, getting back actually into minerals, natural resources, and so forth. Over the last several decades, in fact, outsiders have not looked to the region and seen anything beyond oil and gas, but of course Dubai is quite different in being one of the sort of first post-oil only or economies. But let's talk about how you have grown and expanded in the last decades and what your expansion plans are.
Sure. Dubai Aluminium is the operation started in 1979. It was 34 years back, with the capacity of 135,000 tons of molten aluminum. And now, let's say after 30 years, we are producing 1 million ton of aluminum in Jebel Ali. And also, Dubal is a 50% partner in EMAL, which is a joint venture between Mubadala and Dubai, or Dubal, and that plant is producing 750,000 tons. And again, another expansion is happening with EMAL, which increases the production capacity to about 1.5 million tons, and that's going to be completed by mid next year, and that's going to be the single largest smelter in the world. I mean, that's about the production. I mean, there are no much natural resources in this country, and so we have to import all of our major raw materials from elsewhere. We do have, let's say, suppliers in more than 35 countries. I mean, in all continents. We also sell our products to, we only sell about 10% of our production locally, and about, of course, 90% being sold internationally. We sell to about more than 350 customers in 44 countries in the world. So I said, I mean, we bring the material from outside and then ship our products outside. I mean, in terms of investment, we are not an investment company to go and invest in, I mean, whatever good opportunity is. We do get involved in the potential projects or opportunities which we can secure or source our major or strategic raw materials, and only the materials which having a major impact in our unit cost. So I mean, we are quite active in Brazil. Okay, we're having a project. We are having a project in Guinea. We did have a project in India, which was actually somehow shelved now due to other, political reasons. And also, we are just in the middle of finalizing, setting up another calciner in China. So I said, we do invest wherever we see there's an opportunity which can serve our purposes only.
Let me just a quick follow-up, because a lot of people who watch the energy markets, who watch actually just the commodities markets, are wondering about general flattening of prices in this area. What are your thoughts on global supply issues and prices, and how that's going to affect your industry moving forward? Because there's certainly consolidation efforts in some regions.
Are you talking about the energy prices or the
commodities?
Commodities prices, yes. Well, as you know, the major contributor to our cost is the energy. It's about 40% of our unit cost, and that's the advantage. We had here earlier. People in the world, they used to think that Gulf region is an area where you can find cheap energy. Today is not the case. In fact, we could say it's affordable, moderate energy cost. Availability is there definitely, but it's not as cheap as people thought earlier. That's the major challenge today we are having. If you want to go and expand, or we want to go and get involved in other regional projects, because we know that there are potential projects coming up, in the region, in in Oman, Saudi Arabia, and elsewhere. But that's actually the bottleneck, the energy cost. In terms of commodity, yes, again, I mean, bauxite, which is alumina, is another major raw materials, which is about 35% of our unit cost. We do aggressively look into opportunities to go and put our hands in some, let's say, bauxite reserves elsewhere. But those really, I mean, unfortunately, those opportunities in the countries where there are lots of issues with. I'm talking about political instability, the social instability, and so on. And also, most of it in a very, let's say, underdeveloped region, which you have to put, let's say, not millions, maybe billions in order to be able to take the materials out of those and bring it here. Our third major concern today is the price of aluminum itself. Okay, I mean, today's market, I mean, I could say that more than 50% of the aluminum producer in the world, they are in red. Okay, they are actually, I mean, they're losing money by producing. The only reason actually keeps them producing because of they're having a high hope for the future. I mean, I could say we, at least, I mean, in this region, we are somehow sitting in a, let's say, we're in a better situation, not great situation. But I mean, today, if you look at it, the aluminium should be around, okay, let's say $2,400, $2,500 per ton. But today, market, in fact, was $1,850, okay, $1,900. This is really a very challenging situation for all the producer in the world, including us in this region.
Thank you so much. And last but not least, let's pass the microphone to Mr. Adel Taki, who is the General Manager of Investments for Damak. And of course, you know, Dubai is in many ways synonymous in the global mind with real estate, but within that, Damak really does represent a very innovative company. So I'd love for you to highlight some of the things that you're doing as a firm to really innovate the way in which real estate is operating, and now, obviously not just here, but abroad.
Sure. Good morning, ladies and gentlemen. Damak Properties, in the way it's the flagship business, is a 10-year-old business. We celebrated our 10th anniversary last Q4 of 2012. Damak as a group has been in existence for 30 years. Real estate in Dubai are almost synonymous. It's impossible to mention one without the other, pretty much. We started on the back of the deregulations in Dubai in 2001, where foreigners were permitted to own real estate in the form that they were. Since then, the market has presented with a lot of opportunities to Damak because of a number of important factors that was, most of which were mentioned by my colleague panelists here: the location, the connectivity, the infrastructure, the ease of business. And it's no secret that UAE is the magnet of the region that covers from potentially India on one side and arguably even further to Morocco on the other side. And if you look at this vast population, and you look at a country or a city where you were talking earlier about targeting the cities, it's impossible to escape UAE and Dubai particularly. All of those things put together presented unprecedented opportunities for people to be in the right sector. We were in that sector, and I think because of the way the regulation worked at the time, it created disproportionate opportunity and opportunities both for super profits that attracted a lot of competition, which was good in some way, but it also attracted people who were not necessarily able to continue and deliver in the way the industry demanded and expected its players to do. Damak's story is really split into three major pieces: the pre-crisis, the crisis, and post-crisis. In the pre-crisis days, it was pretty much too easy. One would say that with hindsight. At the time, it felt very difficult, but really, with hindsight, it was very easy compared to what it is today, and certainly compared to what it was during the crisis. And I think we're very fortunate in some respect to have had the crisis that we had as a company, as an industry, as an area, as a region. And I think it's no secret to say the market is recovering, and the recovery, in our view, started in August of last year. We were watching it, we thought it was too early, but now we're very confident that this recovery is grounded in fundamentals. And in some respect, investors were just tired sitting on their money for the period they had. They look at all asset classes that performed. I mean, I was reading in the paper this morning that equity markets have improved 24% or something in Dubai, YTD. Now, I've not looked at the performance of the companies, but I don't think the fundamentals have changed 24%. So there was some certain elements of undervaluation. And if you still look at Dubai properties, and that one would argue we would say that, it's still very attractively valued in terms of luxury and the infrastructure and the total offering it offers. In the crisis, I think it's interesting to speak about the crisis. The industry underwent what you'd expect it to undergo, a lot of major cleanup. The regulations, in our view, came at the right time and came in the right amount. And since then, they've been progressively growing, and I think this one is the fastest growing in terms of regulations and the smartest growing in our view. I think it's done everything to do to help and protect the investor, at the time allow the serious developers to get on with their business. And I think this is a very, very difficult balance to strike in reality. It's easier said than done. And I have a lot of respect for the way that was done. I think it's a combination of regulation, your seriousness, your desire to continue as a serious developer, brought you to think about it differently. Post-crisis, I think we came out of the crisis. I think it's behind us. The lessons are not. We've learned a lot from that, and we've institutionalized a number of lessons that came out of there, and we're taking that to other markets with us. In terms of going out, the first market we went out was in 2005, where we started looking at other markets. As much as people say about the risk in this market, I share fully what my colleague Mustafa says here. It's about your appetite, it's about to risk and return. And when you're on the ground, you understand what's going on, you are able to pick opportunities that others may not see from a desk research or research through hiring third-party consultants. So we're a strong believer in just get on the ground, do your own thing. Currently, we operate in 6 markets. We've delivered 37 buildings, just under 8,000 units. We've got in 14 million square feet. We've got 66 buildings under construction or various stages of development, over 12,000 units and 23 million square feet. So that's in a nutshell where we've come from, what we've done, and what we're looking at.
A quick follow-up is about this innovation and branding, because you are, again, trying to stand out in a way through some of the tie-ups and partnerships that are already on the market and some that are coming upstream. Can you elaborate a little bit on that so that people will know right away what they're looking at and who made it?
Look, the way a loose analogy to compare real estate is really to cars. They satisfy one need. It's the housing in the widest sense of the word. Cars do transport, but then you've got the Ferrari on one end, and you've got cars that are very different value and priced very differently on the other. Real estate is no different. It's segmenting the market appropriately and targeting the right markets and the right products in the right market. We are about building and delivering luxury. We do not have the business processes, the understanding, or the desire to compete in budget real estate development. We just could not do that efficiently enough and competitively enough. So we've deliberately decided which market space we operate in, and based on that, we've cut out segments of the market and positioning products to them. When you look at branded real estate products, I mean, brand is a promise, so you extend that promise onto your real estate. Now, we've We've chosen our brands very, very carefully. We've not just gone with whoever would want to work with us. We've chosen our brands to reinforce and strengthen our brand internationally. And for the more analytical mind, one would be able to infer a lot about our brand through the associations. We've got an association with Fendi, Versace, Paramount, and you'll hear about at least one more in the near future. These brand owners, brand is an important value in their, an important asset in their value creation chain. So they take their brands understandably very, very, very seriously. For them to be able to put their brand out on the line with us makes a strong statement about our capability, about our seriousness, and about our innovation. In terms of specific products, with Versace, we've got 2 towers. We've got one in Lebanon and one in Jeddah. One in Jeddah. And with Fendi, we've got one in Riyadh and one in Dubai we've launched recently. And with Paramount, we've launched one recently. Even the product mix, the location, the pricing, the design, all that takes a lot of thinking and a lot of creativity to bring about. And in the hope at the end, you hope, and you build out some of that hope into the process, that this is something the market will receive positively. And so far, the reaction has been very, very positive.
Thank you. There's some very informative opening statements, and I have some follow-ups for the panel, but I'm going to pause and just see if any hands go up from the audience for some questions. We do have right here in the second row. Is there a microphone for the gentleman here? If not, why don't I just pass you this one? There you go.
Good morning. I've got a couple of questions to Mr. Al-Jarwan and then to Mr. Masoud Dubal. The first one to Mr. Al-Jarwan related to gas. If you can just elaborate more on any kind of commitment that you have or obligation with treaties that you have with internationally with some other countries where you can hinder or it is putting a little bit kind of obstacles for some investors within UAE. As you mentioned, you started exporting. Meanwhile, now you are importing gas. Meanwhile, we have some segments within UAE and here in need of such kind of resources. If you can just elaborate on that. And what would be the futuristic kind of plans, if you've got any, related to providing the private sector with such gas directly instead of going through either DEWA or any other enterprises in the government?
Should we let Mr. Rashid Al-Jarwan answer first, and then we can direct the
Thanks.
second question to Mr. Masoud, please?
Okay. Well, if I understand the question correctly, are there any treaties with international countries that is hindering the gas business or our gas business in particular? And then I think your second question is about the shift between import and exporting countries. So on the first question, of course, the natural resources within the MENASA region is still widely held by governments. I mean, unlike, for example, in the US, but still even in the US, I mean, the state has, you have to deal with the state's own rules and regulations. But coming back to our area here, the natural resources, as I said, is widely held by the governments. The governments would tend to make licensing rounds, bid rounds, and then companies will come and bid for a certain block or area of that area. And then the investor, which is the private sector or even a state company, will take all the risk of investing, i.e. doing all the initial work, then leading to the drilling, to the exploration. So the business itself is quite risky, but you have to manage your risk. And then once you have a successful exploration program, also the reward is high. So that's why it goes with high risk and high reward. Subsequent to that, of course, you end up in the case of Dana Gas, for example, our clients, both in Egypt as well as in the Kurdistan region of Iraq, is the government itself. And you have binding agreements and contracts with governments. But again, the risk comes back again, and we've seen after the revolution, January 2011 in Egypt, our operation continues, alhamdulillah, very satisfactorily, and even there are some growth side in it in terms of production. However, since now we're dealing with a weaker government in terms of paying their bills, our receivable is mounting, it's increasing. And then we have to use our relationship with the government organization in Egypt that we are dealing with, the Ministry of Petroleum, the EGAS, the EGPC. Also, we're highly leveraging on our relationship of the UAE governments, the embassy, the various ministries such as the Ministry of Economy and Foreign Trade. When we have issues common with other companies, also they provide us with their support. However, the Egyptian government will pay what they can pay. And all the rest, they say, don't worry about it. It's yours, but you have to be patient with it. So that's the sort of risk you get when your customers is the government. Our second reputable also customer is the KRG, the Kurdistan Regional Government in the northern Iraq. They are our clients. We produce gas, deliver it to them, certain quantities free of charge so that they can generate electricity. However, we get our revenues from the liquids, the condensate, the LPG. We deliver the product because operation continues on a day, 24-hour basis. However, you don't collect money at the same rate as your production, and therefore the risk of delayed payment is always there. So these are some of the issues that you have with the dealing with governments. But since the mineral resources, the oil and gas is in our region, I must say, the Middle East, North Africa, it's still under tight control in the hands of governments. You have to take the risk and be patient with governments. Of course, governments, they don't work at the same pace as the private sector, so there need to be some compromises there.
So you're able to overcome some of these political and economic risks through patience and through public-private cooperation. Do you want to ask that second question?
Well, still the question, it was related to domestic needs. I'm talking about the requirements, how to cater the local demand within the market, UAE market.
If you like, you can quickly respond.
Yeah, I mean, if I take natural gas, for example, for power generation, for instance, as I said, in the 80s, the oil price was, say, about, at one time, it went down to $6 to $8 per barrel of oil. Now the oil price, $100 plus. So the price of diesel, say, or a better word for it is the fuel oil, the liquid fuel oil. In the 80s, when the barrel was $6 or $8, it was easily affordable source of energy to generate electricity. At $100 of oil and therefore $120 per barrel of diesel, the cost of generating the electricity, the kilowatt hour, whatever, is gone up. And then they immediately realized that they need to switch from liquid fuel oil such as diesel into natural gas, because natural gas, as I said, did not realize its value in our market. In the West, in the US, in Japan, it's liberalized fuel market, so you have to pay what the market demands. However, in the Middle East, in the GCC, Saudi Arabia sells the natural gas, for example, to its industrial partner SABIC at $0.75 or 75 cents per million BTU. The same price for gas in Japan now is $17. So there's a huge difference between less than $1 in Saudi Arabia and more than $17 in Japan.
So what would be the scenario here within UAE, within Dubai?
So the government, the area here has realized that they need gas to switch. Hence, they had the project to import gas from Qatar through Dolphin at prices reasonably reflecting the cost, but not the full liberalized price of gas. Also, the government of Abu Dhabi is investing hugely in developing extra sources of gas, such as what they call the sour gas, where the percentage of the sulfur, the H2S, is as high as 40%. There are at least 2 major projects in Abu Dhabi, $10 billion of value each. One is near completion and should be starting to produce the sour gas from Shah Field in 2014, I believe. The second one, we just read about it in the newspapers today, that ADNOC has awarded Shell another project to develop sour gas in the Bab field for a similar amount of $10 billion. So the source of gas in the UAE is available. The easier gas has been produced. Now they're going into the more difficult gas to get. Importing gas from the region. For example, Qatar is known to be the 3rd largest gas resource in the world. And alhamdulillah, we have a pipeline that flows from Qatar to Abu Dhabi into Dubai, networked throughout the UAE and reaching Oman. It's a great achievement. It's totally consumed. There are more demand for gas, for the aluminium, for the electricity, and for whatever else you want to think about it. So that's phase 1. Unfortunately, the second gas project, where Crescent Petroleum and Dana Gas also entered into, was a great idea to import also gas from Iran. Iran is the 2nd largest gas resource in the world after Russia. Due to many reasons I will not get into, that project did not fulfill its obligation to flow the gas from Iran. So the sources of natural gas, Abu Dhabi is primarily the main source of natural gas for the UAE, and the import from Qatar is the second. Thank you.
Is there a specific question actually for Mr. Masood Ali of Dunal?
Since you are lacking the natural resources for aluminum, what would be your contingencies plans? What do you have next? You are focusing only on the core business of aluminum. So what would be the non-core business that would support your core ones? Thank you.
Actually, I was expecting this question for this forum. I mean, I remember maybe 10, 12 years back, we had a project in the company to go into downstreams. And then the first thing, our CEO told us, okay, we know how to make aluminum efficiently, so we focus on our own business. I mean that's the strategy of the company. But we do really encourage all other investors who want to have any kind of investment or projects, anything, either next to us or in this region. We really could support them I mean, some of them, even if they need, let's say, liquid aluminum or molten aluminum for them, because when it's exported, all of them in a solid form. So instead of getting in solid and then liquefied it or melt it again, we could do, supply them even molten form. But for ourselves as Dubal, our strategy remains only in the field of smelting process itself. So as I said, we have grown here in Dubai, in Jebel Ali. We have grown significantly in Abu Dhabi in collaboration with Mubadala, and also we do have many other initiatives, which is some of them may even be announced shortly in the region. So I mean, our business model is only smelting.
Excellent.
The second question was, the second question for Dubal, it was
actually what we're going to do is
related to the environment, how you are managing to rectify whatever ruined it in the
very, very quickly, and then let's, if you could pass the microphone, please, to the gentleman in the front row who will have the next question. But in the meantime, okay, sir.
Thank you. Ben McGregor, ICD Brookfield. Mr. Khan, my question to the panel is a real estate-based question. Mr. Sajwani, you mentioned that prior to the GCC, there was perhaps the market was too easy for developers, which led to some developers entering the market that potentially did not deliver to the quality for the longevity of Dubai. I wanted to ask a question to the panel, but also to yourself. What lessons were learned in the GCC and the subsequent correction for the market? And what could Dubai do to protect the longevity of Dubai to make sure that these mistakes are not made again?
Okay, so for I think two of our panelists, or several who are involved in this sector, when we talk about post-financial crisis lessons learned.
Okay, I'll try. I think it's a very good question. There are lessons that are learned at a company level, and there are lessons that are learned at an industry level. I'll talk about the company level first, and then we can try to touch on the industry ones. At a company level, I think there are a couple of technical things that we've learned out of this. And one goes as simple as this: cost is cost, and it's always important. It doesn't matter what the market is like, and I think that lesson is true in any business. And a dollar is a dollar, and a cash is cash. Some really basic fundamentals that sound almost too simple and too trivial, but very often, and Mustafa and my colleagues can add to that when markets get excited, it really almost gets silly. And we've always had our own personal experience of that at some level. And you just got to ground yourself, and you got to look at the macro trends all the time, and you look at the fundamentals, and you got to, you feel things where they're not right, and it's very often easier to tell with hindsight, but we've institutionalized this by asking ourselves constantly, does this sound right? Part of what I do is look at a lot of markets, and my focus has recently been Asia, and there are a couple of markets where I feel, whoa, wait a minute, this is a disaster waiting to happen. And I don't think we would have had that ability had we not gone through the crisis. But that's one very important lesson. The other important lesson is that you've got to not borrow more than you need. Where you have to be very serious about defining and how you define what you need. Real estate is the sort of asset that when markets are good, bankers just can't lend you enough fast enough. And when markets are down, they just will not return your call. It's as simple as that. And then you get people like Mustafa coming over to you and telling you, hey, here's the money at 37% a day or something. It's only joking. So I'll cite you an example in Business Bay where a GFA cost was trading for 600 dirhams a square foot. Banks were just too eager to lend you money for the land at 50, 60% LTV. Any sensible lender or borrower will tell you it's just wrong to borrow for buying land. It's just so wrong. And very often, you've got the land and they just refinance the land, release a bit of equity, and you do what you like with that money. That's just not right. And I think that's very, very important. When the market tanked, the same asset on which they were lending 300-400 dirhams a square foot, they would not lend you 50 dirhams a foot. Same asset, same city, same infrastructure, the same external factors that make up certain intrinsic value of the asset, but there's no money against it because the market was not as crazy. So that's second very, very important lesson. Thirdly, and it's a bit of a self-discipline, we now have institutionalized the escrow management system in its various shades and forms. You've got the American model, you've got the UK model, you've got the Australian model, the Dubai model, but any model is a good model, and you need that financial discipline. You sell your properties on a certain basis, you collect money on a certain basis, you apply that capital on a certain basis, and you make the money you need to make as quick as you can, as efficiently as you can, but you need to have the basic fundamental financial discipline. And I think it's very easy to lose sight of this. And I think it's a discipline you either have or you don't have. It's a bit like smoking or pregnancy. It's very binary. And as soon as you start saying, well, it's just a little bit of this, and it's only 2% of my balance sheet, and you are on a slippery road. The third or the fourth, that's very, very important lesson for us, is that we will not launch something into the market until we've got the contractor, the main contractor on board. And for those who are from the industry or know a little bit about the industry, there was a time where you bought a piece of land and you launched it a week later. When you get the main contractor on site, you're talking about pretty much 2 years after buying the land. And in that 2 years, you're de-risking in some ways because you're closer to execution and delivery, but you're putting a lot more drain on your equity, on your capital. But that's the way this business should be done. And I could go on forever, but I'll leave.
So those are very interesting points about discipline, transparency, preparation. So let me ask Mustafa and Douglas also to weigh in on some of this. What would you add to this question?
I mean, like any market, initially the absorptive capacity is limited, and when there's a rush, there's a rush, and then it leads to cycles, and cycles are going to happen. It's human nature. That's why we have cycle after cycle after cycle. So some lessons are learned. But in the long run, you continue to have these cycles, and it's the way they play themselves out. The idea is the market here, and I can speak about real estate specifically, it's not necessarily my area of expertise, but generally speaking, when you're talking about whether it's the financial markets or the real estate markets in general, both from a regulatory perspective and in every other way are going to become more sophisticated as a result of the experiences that you go through. The challenge with the regulatory evolution is you're always regulating for what just happened, and that's good, that is progress, but you need to be flexible enough and have enough release valves to make sure that issues don't sort of creep up again. And I think the lessons from the previous crisis, specifically the real estate crisis, were deep enough, harsh enough to leave a bit of a long-term reminder in general. And just as an observer and a participant in this market, you realize that definitely there's significantly more discipline. You look at how the escrow regulations around the escrow, the regulations around mortgages, everything else, at least thought has been put into the process as to how we work on this. And the same thing is happening with the financial markets as well, because again, these were very, very small markets to start with, huge inflow and very limited absorptive capacity. You get asset inflation, and then you get a bubble and it bursts. And then obviously, again, add leverage back to the equation, and it's a very deadly combination. I think a lot of that has been ironed out of the system to a large extent.
So the financial and capital market issues are also extremely important lessons learned, for sure. Douglas, please.
No, I think these guys have answered the question pretty well. I think the capital structure is very important. Prudent capital structure always. Lending against land is something I would really question were I a bank, as there is no cash flow, to repay the loan. And so, you know, that's just a general point globally that we look at. I think one other point that maybe didn't get touched on, Business Bay was mentioned. You know, one of the issues when I look at Business Bay is something like 17 of the 19 office buildings within Business Bay were sold off strata title. You know, perhaps enhancing the regulation and rules around strata title and landowners, or rather owners, how they work in common for service charges, things of that sort, would be useful. As a commercial point, this is just something, it's my own personal view globally. Strata title is something that can work residential, but not for commercial. If you've got a building that was sold floor by floor, and so 60-story building, 60 landlords, you know, a large multinational is not going to want to deal with multiple landlords, you know, to secure their lease. So, you know, that leads to questions around how commercially, as a business model, do you make that work, and is something that probably needs to get worked through if somebody's really going to consider strata title on commercial buildings. As a general point, that's probably not something we do.
Right. So some lessons around making things more efficient for the consumer. We have time for one more question, I believe, and who would that come from? Let's see. Hands over there.
Thank you very much, Nezha Ashenbrana, an advisor on investment promotion. I really appreciated hearing and listening to your very illuminating insights about various important sectors in the UAE economy. And I have noticed the really dynamism that seems to be, you know, that you seem to convey as companies investing in various countries, particularly in this region. I would like to ask, as an investment promotion agency, as a country who is really interested in attracting some of your investments, what kind of message would you like to convey and say? What are you're looking for, you know, your strategy, your motives and drivers, you know, that you would like to select one destination on the other? Because I noticed that you are located in some countries, Egypt, you know, other markets close by, but I didn't really get why did you go to this specific market or another? Thank you.
Maybe a quick, who is there any specific person to whom you'd like to direct that? Everyone?
Any of you.
Maybe then a
I think it's
comment.
very different sectors. You know, we have the property sector, really high-end property sector. We have aluminium. You know, we have financial sector. You know, we have. It will be interesting. It's different, probably different motives.
Sure. I mean, we've invested in lots of different industries, from healthcare to industrial services, financial services, everything else, and including a number of businesses in the UAE. So I think what makes a destination like the UAE attractive, or any other destination, in fact, I mean, very simplistically, is going to be opportunity and then your ability to access that opportunity. So I think when you look at the UAE, there's the growth. That's a good foundation. I think the UAE is one of the large economies in the MENA region, but what is even more relevant is if you're looking at businesses that seek to access other markets, the UAE is a good platform for that. So there's a number of businesses that choose the UAE as a location to access the region, and we find that it's a great place to do that for not just from an access perspective, but from a talent perspective, because one of the most important things about running a business is being able to attract the right talent into these businesses. And you'll get both from a local talent pool and from a global talent pool, your ability to recruit in Dubai. You don't even need to sell it, and the UAE in general. So I think that is definitely a big factor. One of the things we like to look for, and it's very, very important, is, and you know, we've touched upon in this panel a little bit, is governance. If somebody's going to accept my capital, that comes with obligations as well. Right? So a lot of times we look at businesses that we feel are good businesses, but in our view are not good investments. And there's a big distinction. Because if I'm going to be a partner in your business, it's not about, you know, taking the money and moving on. So we look very much for, not even if the governance levels don't exist at the level we'd like to see, but there's an aptitude and an understanding of the changes that will come with the change of ownership. So that for us is a big thing.
Does anyone else want to take a stab at that? If not, I'll ask one question actually of everyone, if I may, and it really is about risk, and I think this would be very educational for the audience. There are three kinds of risks that I wanted to ask you about as you project moving forward with your international operations? Geopolitical risk, for sure, disruptions to supply chains and so forth. Reputational risks as well, you know, given the tight linkage between business and government here, what risks might you foresee? And then economic risks. What about protectionism issues from in some of the markets that you deal with and other kinds of economic factors? So you're looking broadly at the issues of risk as you move abroad. This is obviously going to be very intrinsic in a way to factoring your global operations. So if each of you could comment about, and again, for the UAE companies and regional companies in the audience, hearing from leaders from companies that are based here, how are you managing these kinds of risks? Please, you know, feel free. I'd love for each of you to comment briefly on this.
I mean, as we look at investing on a global basis, you know, with real estate and property, it begins with property rights. You know, and what is the rule of law in a jurisdiction? You know, how long has that been in place? How stable do we think that is? Sort of those go hand in glove, if you will. The other side of it is supply and demand, barriers to entry in that market. You know, there needs to be demand. Again, that's driven by sort of all of the things we touched upon that make Dubai and the UAE, I think, such an attractive place for people to do business. But whether it's infrastructure, whether it's ease of doing business, regulatory frameworks, et cetera, you know, it's important that we see that, because if there's not going to be sort of new business and growth in business in a market, they don't have needs for sort of more office buildings, et cetera, and so forth. But just because you have the demand doesn't necessarily mean you've got an interesting supply-demand, you know, dynamic. The other side of that is, you know, how easy is it to build? How easy is it to get planning and these sort of things? Because in a lot of markets and through the crisis, I would say this happened in numerous markets, it was very easy to build. People saw the demand, but they overbuilt for that demand. And so as soon as sort of the economies, whether it was, you know, second homes in Spain or wherever, sort of came to a halt, you had a lot of excess supply, which led to, you know, huge drops in pricing, huge drops in rents, which if you're an investor and an investor for the long term, it means it's not such a great investment.
So now forecasting forward, you don't worry about demand contraction in the Manasa region at all?
Demand contraction, no. Slowdowns potentially in certain markets possible. Yeah. But I would be looking much more at what do I see as the potential supply, competitive supply against which, if we're building new office buildings, new logistics, that I'd be competing. Because again, just because you have demand doesn't necessarily mean I've got an interesting investment.
Right.
If there are 2 warehouses built for each new, you know, user of a warehouse, you're going to have a problem.
Yeah, price-wise. Yeah.
Yeah.
Mr. Rashid, please.
Yes, within our company, Dana Gas, I would say we have almost a structured approach to risk management. Wherever we have a new opportunity to invest, for example, we have a risk matrix, we have risk identification, all the elements are identified, whether they are operational risk, safety risk, political risk, and then you see what are the risk mitigation. Once a year at least, also we present to our board of directors the risk management system that we have in the company, because as I said, we're dealing with we are focused in the Manasa region. We believe the company understands also the local or the regional political environment and risk. So you try to mitigate your risk by having proper contracts while doing business, and then you're expecting these contracts to be respected. So I think this is, we've realized that it's important for our business to have a structured way to look at it and identify it, see what are the mitigation, and just assess any business opportunities against the risk. After the assessment, you may drop an idea of an investment. you may delay it, or you may take that opportunity of investment, provided that you've identified the risk areas and the mitigation process as well.
So, I mean, given the industry we're in, it's at the very core of what we do, risk management, and we were probably one of the first PE firms globally to build a full risk and compliance function within the firm. So we address it in a number of ways. Obviously, so on a portfolio basis, we are diversified by geography, we're diversified by industry and everything else, so our exposure to any one investment gets limited. But also, within the individual countries and geographies, we make sure that we, as everyone else was saying, that we understand the nature of the jurisdictions we're operating in, the ability to enforce. We manage risks also through the deal structures we put in. We spend a lot of times with our counterparties before we invest, because there's the counterparty risk. We work with others. At the end of the day, we need to be comfortable that these are, to a very large extent, the right counterparties. We work a lot on governance, but then for a very simple reason is the more transparent the business is, the less surprises, both positive and negative, and then you can manage it a lot more efficiently. So there's a very active plan working on governance and reporting, and all of this is measured. And I think the key is it's not just about measuring and all the analytics around risk management, but taking a very holistic approach around how you view risk in general.
Well, as Mr. Jarwan said that, I mean, there's always risks in any business. In our case, I mean, if we just go back to your classification of, I mean, political risk and let's say geographical risk, as well as the market itself. I mean, politically, I mean, everybody knows that. I mean, the country itself is very, very, very stable. Okay, there's no issues. We have no concern at all. There are some concerns, okay, regionally. I mean, specifically if we talk about the Strait of Hormuz, which we always from time to time we see that, okay, I mean, there's threat of closing that strait, and that will having a very big impact on our supply chain, in fact, because all of our raw materials coming in and then going out from that particular route. For coming in, really, we don't have much, let's say, alternative. There are alternatives if we go to Fujairah, for instance, which is going to be very costly for us. But we actually looking at it that 25% of the world oil is being transported through that route. So if such thing happens, the country is a much bigger risk than ourselves. The region is a much bigger risk. So they have to take action much faster, and then we'll be, getting the benefit of that. In terms of market itself, I mentioned earlier it's a very weak market today, but if you look at historically, the demand for aluminium is about 3 to 4% increase annually, and that's historically has been proven. And in today's market, let's say production of about 45 to 50 million tons every year. So you would require about 1.5 million tons every year production increase. So there are always demand for that. Okay, it shifts from one geographical location to another, but globally there's always demand for that.
In our context, we look at risk in different ways. I mean, if I just pick on the political risk, we've stopped guessing there. It's just impossible. After 2011, a little incident can set the world to a different place. However, you do what you can from what's available out in the research. What is very important to us is the opportunity and understanding the demand, but also, as Douglas said, is the supply. It's how much coming on stream, what's coming on stream, in what segments. And the law, the title, the land acquisition, the courts, the judicial system, all of that is very, very important. And then accessing the money back. We go in there, we deploy capital, we create value, we leave. So in a nutshell, it's going in, executing, and going out.
Excellent. Well, unfortunately, our time is running out for this panel, but I think what we've seen here, particularly from this distinguished panel, is that not only does the UAE have high flyers, as the title suggests, but also strategic thinkers. And one of the underlying themes of the discussion has been the growing global competitiveness in all of your sectors, and yet you seem very confident in the ability of UAE-based multinationals to thrive in that environment. And so I think we will have high expectations from all of you and from the UAE in general. Please, members of the audience, join me in thanking our distinguished panelists for their very insightful remarks. And after this, I believe is I believe now comes the lunch break, if I'm not mistaken. So we will reconvene after that. Thank you all again for being here at the AIM, and thank you again for joining us in this session.